Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Well, looky-loo, it's Mr. Michael Becker, the smartest guy in the room, joining us today. Michael, how are you?
Paul, doing pretty good. Summer's finally gone. It's not 1,000 degrees here anymore, so football's back. It's been a good start to the fall so far.
Yeah, it's the temperature's come down a little bit. In fact, it was last Saturday. I actually had to bring a coat out because it was a little chilly on the back porch. So that doesn't happen too often during this period of time, but when it does, it's very much welcomed. So, today we're going to be talking to Nick Fluellen, and Nick is part of the Fluellen Hoover team. So it's Nick Fluellen and Bard Hoover with Marcus and Millichap. And when you think those two guys, and they have a team of 20 folks on their team. But most of the time you think of those two guys, you think of just Dallas-Fort Worth. And I think what we'd like to do today is get a little bit more information. And things that we want to talk about is having Nick talk a little bit about more of the areas that he covers, and his team covered, not just Dallas-Fort Worth, but other parts of Texas and Oklahoma and Arkansas too. So without any further ado, I'm going to throw it over to Michael and let's talk to Nick Fluellen.
Yeah, Nick, maybe we've had you on a couple times at least at this point, maybe three. Been a little while since we last had you on, but for those of you not familiar, maybe do a little kind of brief poor man's introduction to yourself and what you do every day.
Sure, guys. Well, thanks for having me on. It's always good to be with you guys, and always good to connect with the podcast listeners. And every time I'm on, there's more of them. So that's a great thing. So, Bart and I lead a team of 20 here. We're based in Dallas, but, really covering this entire region and, not just the major markets in Texas, but, secondary, tertiary markets, East Texas, Central Texas, West Texas, and then, surrounding states, New Mexico, Oklahoma, Louisiana, Arkansas, et cetera. And, it's been exciting. I mean, everyone listening who's been following the multifamily market in Texas knows that the market is certainly red hot. But we are, not just having a tremendous amount of success in DFW, but, these other markets have been extremely lucrative and desired by a number of private investors who are just looking really for an alternative to some of these markets that are so hot. So as we stand today, and we're beginning of September, I mean, we've closed 46 transactions this year, 14 of those in, secondary, tertiary markets outside of DFW. And so that's a great sector for us that's really growing in an area that I continue just to see a ton of opportunity. A lot of mismanaged deals in those markets, or less sophisticated management in those markets, and more properties that haven't been upgraded. And while the metrics aren't exactly the same, the math still works. And an upgrade, is an upgrade. You get a $50 bump instead of $100 or $150, $200 bump, as long as you're not spending a fortune to get that $50 bump. The math works really, really well in those markets. So anyway, that's year to date, I think we've done about $550 million. We've got over 20 deals in escrow right now, and have probably another 10 or 15 that very well could close before the end of the year that are at some point in the marketing process. So it's definitely conceivable we could do 80 plus transactions this year. We will certainly do $1 billion plus when it's all said and done. So obviously, great year in multifamily. And
what was that say last year to compare from a transaction volume size?
I think we did maybe 600 or 700 million last year. Last year was off to a really best start we've ever had, but obviously with COVID essentially knocking out a quarter of the year, it was a little bit less than that. So I'd say we're about 20 deals ahead of last year's pace, at least, and I don't see that slowing down anytime soon.
So we talked, Nick, interviewed you, recorded, I think it was in December of 2020. Last time we talked, I remember distinctively talking to you about how I just bought a deal, brand new Class A deal, and got like almost 80% leverage with an agency loan. And I remember you and I just talking about how either one or two things had to happen. Either interest rates had to go up or cap rates had to come down, because it just made no sense to be able to get an agency loan. This isn't like some, a bridge loan on pro forma. This is on actual numbers. And so, boy, it sure looks like cap rates compressed out there. What's different now than, say, 12 or 9 months ago, like in the marketplace, the buyer pool, level of interest, types of players coming at it? What are you seeing that's kind of changed from last time we talked?
Well, yeah, no question. Cap rates have definitely compressed even more. I know, heck, we were talking in December thinking, man, the market's really, really hot. It's amazing how quickly we've rebounded from COVID. And, I think as hot as we thought it was then, I think it's obviously even considerably hotter today. I mean, heck, deals I sold in the first quarter this year, I feel like people are already way into the money on, which is crazy, but it's just been that big of a shift upward in the market, and cap rates, have continued to go down. The interest rates, if anything, are less than they were when we were talking then. I will say that by and large, nobody's putting agency loans on most of these deals that we're selling. I mean, almost everything is a bridge loan. So not necessarily the absolute lowest rate you can get by doing that, but obviously with the way the market's moving, that flexibility is king for everyone right now.
How much of that is you think is fueling the price increase? I know that's what Paul always says. A lot of these bridge loans aren't for the buyers or for the sellers to get a better price. Is that a pretty large part of why you think the pricing is escalating?
I think it's a couple things. I mean, with where values have gone, first of all, I mean, it seems to me any deal that's being bought right now with where cap rates are, it's definitely a situation where a buyer is going to have to work to get that IRR, and it's going to have to work to get the equity multiple that they're targeting, right? And so with that basically means that if you were just going to put a conventional agency loan on it, the leverage point is not going to be great, even though a lot of your other terms could be very favorable. The leverage is less, and so to your point, a buyer is going to go with a bridge loan to get more leverage, and not that is still much cheaper than the equity. That debt is still much cheaper than the equity, even though the rate may not be as low as the agency situation. So I think, obviously it's helping sellers. That the bridge market is helping sellers push prices. But I think whether it's unintended or not, I think it's ultimately going to probably work out better for buyers to have that flexibility. Maybe they're doing it to maximize their leverage, but I think at the end of the day, a lot of owners, I know, yourself included, Mike, could look back and feel like, hey, I've got a huge prepayment penalty here. It sure would have been nice if I'd have put something on this that had a little more flexibility on the back end. And so I think that's what we're certainly seeing, with pretty much the vast majority of deals that we've done this year.
I don't disagree, and especially that we put out a flyer the other day that talked a little bit about getting tattooed. Putting a tattoo on your body is a kind of a permanent thing, whether it is on your body or being tattooed with a loan that doesn't work for you, and maybe one that has a step down prepayment penalty or has a yield maintenance or defeasance. That's certainly an issue with the sellers these days that have wound up with these large yield maintenance penalties. And so maybe a bridge loan would have been pretty good a couple of years ago, would have given them the easy out. So always tough to come home with not a nice tattoo to show your mom and dad that you probably should not have done that. But thinking back, probably the multifamily space, maybe a bridge loan was a much better option for people to get into. So, with Nick, men want to be like him and women want to date him. And so he has this team all across the region of North Texas. And so talk a little bit about some of the areas that you guys have coverage in, that if somebody wanted to get into some of these areas, tell us a little bit about geographically where you're at.
Yeah, I mean, I think the easiest thing is anybody can certainly always contact me, via email or give me a call if you're interested in a particular area, and I can kind of connect you to the right person. I mean, we're really getting a lot of traction in a lot of these markets, and we've done a bunch of deals in Central Texas. We're starting to do more and more out in East Texas, and have always had a pretty good presence in West Texas. But these surrounding states are areas that we're really just trying to keep growing. And so it's, it takes a little time to build those relationships and all that. But, we've had a good amount of success targeting certain assets and approaching it that way, or approaching owners who own assets with certain characteristics. Hey, I want a 200 unit deal built in the 80s in this submarket. We've had a good amount of success going about it that way. It's obviously harder to go pick off deals like that. And it takes, the right buyer and strong terms and the right kind of financing and all that. But, I would say every buyer's different, every owner's different, every property's different. And so if you have some interest in being in one of these markets, let's talk and let's come up with the right game plan that makes sense, whether it's pursuing something on market or pursuing something off market.
That's great. And so areas that Nick and his team cover, again, Nick is the funnel that you go through first. It would be areas like Amarillo or El Paso or Midland, Odessa, or out in Oklahoma City or Tulsa or Ardmore or Lawton, Oklahoma, up to Fayetteville.
Tyler, Longview, Nacogdoches are all places we have deals in escrow right now too. Waco.
I'm just walking through the map here with you, and just amazing the amount of coverage that you have throughout the North Texas area. And then it's not just the B and C class properties, but you're also the funnel to get to the institutional properties too, the higher quality assets too. And so talk to us a little bit about the higher quality assets that you offer.
Yeah, well, I mean, obviously here in DFW, our colleagues at IPA have done a really phenomenal job, and we work very closely with them and have a great relationship. So that's a great asset. And we like a lot of owners, over time want to start gravitating towards newer stuff, bigger stuff, and so we've worked really well in trying to help people transition over into that world. But I would say outside of kind of the four major counties, we have done a ton of these newer, larger assets. And I think what you find is you have a lot of mom and pop, smaller developers, guys that are building a project at a time, and may not have the most decked out amenities like you'd see in an Uptown or some of these other really vibrant markets in DFW, but you still own a really, really nice asset that's got a lot of the features that everybody would like to have moving forward. And so we love working on those deals. And like everything else, look, I mean, it doesn't matter where it is. Maybe the dirt's cheaper in some of these smaller markets, but I mean, construction costs are rising. And so just a chance to buy some of these deals now, I think people are really going to be in the money moving forward, because any new deals are going to cost a lot more, and they're going to have to charge much higher rents in order to get the economics to work. And so that's really what we're seeing in a lot of those markets. But we are definitely seeing more and more investors who are flocking to the newer stuff.
So you say earlier, you said that the ability for a lot of these groups to kind of buy bigger and bigger deals from the private capital side. Are you seeing any change and shift in kind of the buyer pool, like who's making up the buyer pool today, say compared to 12 or 18 months ago? Is there anything kind of takeaways or something surprising to you that it's kind of shifted within the buyer pools?
I mean, I think a lot of the same players are out there. I mean, as always, there's new people entering into the market. And so it hasn't been a dramatic shift in necessarily buyer type. I would say that we've probably had more 1031 buyers this year, either, at least looking at deals, whether they're the ultimate buyer or not. than I can remember in recent memory. And I think a lot of that is maybe some of the political climate in some of these other states has made it very difficult to own and operate, real estate, and they're kind of flocking to some of the the hotter markets that are not necessarily on the coast, Phoenix and Texas, the bigger markets in Texas, and specifically, Dallas Fort Worth, where we've had a lot of people that have called. In fact, I have a call to return from one of my colleagues on the West Coast that had emailed me earlier and said, "Hey, I got a client that's in an exchange that really wants to be in Texas." I've had a lot of those this year, more than I've had in a number of years. So I would say that's probably the biggest thing. We'll see if that's a short-term thing or if that's something that continues over the next 12 to 24 months. I suspect it probably will. I also think some of the activity is spurred on by uncertainty around, whether the 1031 exchange is going to continue. I mean, I think it probably will, but at this point, that's not necessarily, 100% known. And so I think there's some people that are thinking, well, I'm going to try to get this exchange done before the end of the year in case anything changes next year.
So you've been to a lot of weddings in the past, bridesmaids and groomsmen, but in the multifamily business, there's been a lot of bridesmaids trying to become the bride themselves. Any helpful advice to people that are coming into the multifamily market that may have not gotten their first transaction? Yeah. What wins deals these days? What's probably the first three things that come to your mind of how somebody stands out from somebody else?
Yeah, well, I think ultimately, while everybody would love to get bigger and buy bigger deals, look, that market is ultra competitive. I think that if, I was talking to a private investor who's looking to move up, I might just say, hey, look, don't fall in love with just a 300 unit deal. You could probably go buy 250 unit deals and have better odds of probably winning those deals than continuing to be the bridesmaid on some of these larger assets where you're competing with some really, really big players. And so, to win these deals, people have gotten even more aggressive. It used to be, hey, you go hard with six figures, you're ready to play, right? Well, 100,000 hard now is nothing. Heck, our small deals, have more than that, which is crazy, but that's just where we're at right now. People have to be willing to come with something that tells the seller that they're not playing around, and you choose that buyer, and it's a done deal. So, I think making the legal process easy that's a thing that I think is pretty undervalued. It's great if you're going to go hard with a lot of money and you have all these great terms, but if it takes 3 weeks to get an escrow, you've kind of defeated the purpose. So I think people that really can be nimble on that front, people that are really organized and leave, a small footprint on a property. In other words, hey, I'm not going to go in and inspect this unit 3 times during my due diligence. I'm going to try to set up the due diligence and the third parties and everything on the same day so I can cause a minimal disruption of operations. I think those things matter, and so, at the end of the day, it's basic stuff. And so these are just, ultimately the highest price with a lot of hard money is still probably what it's going to take. But if it's tight and a lot of people are willing to do that, and that is the case right now, these are some of the little tiebreakers that I'm seeing people, articulate that are effective. So just, at the end of the day, just being a very easy buyer to work with is very meaningful to these sellers. And look, these seller interview, buyer interview calls, be prepared for them. That's your audition. You're on an audition to be selected as the buyer. And while it sometimes may seem like, okay, I have to do another one of these again, I think people that approach those with a strategy and with a message they want to clearly get across to the seller, I think they see really good results. And sometimes it's enough to win them a deal in a tight deal. So that's just a couple of little nuggets that I'd throw out there for someone.
So Michael, you sold enough of these deals in your past. Pricing number 1, pricing number 2, 3, 4, 5, 17, just some of the things that Nick was talking about in your little world. where's pricing at? Because sometimes
No,
people
it depends on the
focused only
situation.
on pricing.
Yeah, it depends on the situation, right? I mean, so if this is a deal that I can't wait to sell, and it's been a pain in my butt, and equity just really needs to get out, and you got a certainty of execution. A good example: we're buying a deal we just got awarded, and the seller is a tenant in common, so it's like one experienced principal, and he's got some brother-in-law type money in the deal that is really unsophisticated. And it was kind of a pain in the butt, and he got them to agree to say yes. So certainty of execution is of utmost importance to him because they don't want to go back and get a second yes. Once you get a yes the first time, that matters. Where if it's a syndicated deal and I control the situation, certainly I don't mind going through a little bit of extra work to get the highest price because I can just make a decision on my own. So I think a lot of it, like everything in this business, is very situational. So kind of reading the room, and so if I'm on the other side and trying to bid on a deal that Nick is selling, I want to understand who my counterparty is in every transaction. So kind of understand the setup of what the seller is trying to accomplish. Might give me a little tip on maybe how do I craft the offer and my presentation to it. And, that's one of the things that Nick should know the answer to that question, right, Nick? If Nick's doing his job, he needs to know what is most important to the seller. And usually price is number 1, 2, and 3, but, sometimes it's not. And there might be some extenuating circumstance that you as a buyer in the buyer pool, if you understand that and the other guys don't, might get you a little leg up.
No question. And I would just say at this point of the year, I mean, you certainly have sellers who are very bent on closing before the end of the year, right? So somebody that can move a little faster, or somebody that might not be cutting it close to the very end of December, might get some preference, right? If you're trying to close at, December 27th, and there's any sort of hiccup whatsoever, that could be a problem. And so, hey, maybe somebody that wanted to close 2 weeks sooner could be in a good position. So yeah, it definitely varies, and everybody always has a different motivation. And, sometimes there's a good, compelling, intangible reason, to choose someone else. But yeah, I mean, I think that's it. Come up with a strategy on every deal, do your fact finding and make a good plan from there and see if you can take some stuff down. It's hard to win these deals. And so, you got to be a good thinker. You got to be playing chess and not checkers here. So
where do you see multifamily going right now? I mean, you've seen rents just rise tremendously in the last, say, year or so. At some period of time with the B and C class, are you starting to see we're starting to hit a top at all? Or are we starting to see some pushback? What are some of the tea leaves that some of the folks over at Marcus & Millichap are predicting?
I actually am pretty bullish on where the market's going to be in the next couple of years. I still think all these new construction deals and there's going to be a little bit of a lull in that front. But again, the rents that they have to charge, there's just such a dramatic delta between new construction and Class C and even Class B. And so I think, relative to the rest of the country, we are not anywhere close to being the highest price or anywhere in the realm of, as a percentage of income, what people are paying for housing here is still very low. And so I definitely feel like there's plenty of room to keep moving upward and to keep pushing. And as long as we keep adding jobs and keep adding population and keep building expensive new deals, then I think everybody is going to be in a really, really good position. I will say this, I was talking with a client at lunch today, and a few years ago, I told him, I said, hey, listen, all these 80s deals, he was stretching and buying an 80s deal for, I don't know, somewhere 75, 80 a door, a few years ago. And I said, man, I know you're stretching right now, but I'm telling you, it's just a matter of time. All these 80s deals are going to be 100 a door, and it's a matter of time, sooner rather than later. And I mean, obviously, we've blown way past 100 a door. And I would say the talk track I have right now is people that are buying these 80s deals for 150 a door, 175 a door. It's just a matter of time before those deals are going to 200 plus a door. I mean, the new construction deals, are some of these are approaching 300 a door already. So, look, it's all that stuff has a trickle down effect, and it makes these deals a relative bargain when you start kind of comparing them across the board. And then, likewise, that kind of has a trickle down effect into the secondary, tertiary markets because, hey, I bought the steel in Dallas and it was 125 a door. Man, it feels pretty good to buy it for 75 a door, even if it's a much smaller market with a lot less growth and all that. So that's what I see. I mean, I think, the frenzy that is out there for 80s product and newer right now is insanity. The buyer pool is so deep and there's so many people that want to buy these deals and are willing to really stretch and really, accept lower yields. And I still think they're going to end up looking really, really good here by the end of that holding period. Cause I feel like the market's going to keep going up over the coming years ahead.
And Paul, I just got off a call with my property management company, going to do a quick little review and talking about renewal rates and retention rates, and kind of looking forward when we do renewals where 60 days or better in the future. And the last, say 3, 4, 5 months, we've been seeing probably 5 to 7 to 8% kind of rental rate bumps on renewals, and we're probably seeing mid to high teens on new lease trade outs where you actually turn the unit over and get someone in. And my portfolio, really, we're not doing any value add. These are all just kind of organic rent growth. So I'm sure if some of the stuff that Nick sells, if you go in and spend 7,000-8,000 units to renovate it, you can get those bumps. This is just organic rent growth. Well, kind of looking forward, I mean, I think what they're saying, their entire portfolio wide, they're seeing kind of 8-9% rent growth going forward on the leases that they are going to renew that haven't actually booked into the rent roll or hit the income statement yet. And they're seeing like mid 60s retention, which is, you're normally lucky to see 50% retention. So you're seeing, much higher retention, you're seeing much higher renewal rates. So I don't see what stops it for, the next several months. I mean, it kind of the saying around the office here lately, it's been kind of all gas, no brakes. And that's kind of what the whole mentality is. This is all gas, no brakes. I don't see what slows it down for the foreseeable future. So hopefully we don't run into a wall here at some point, but right now it's all gas, no brakes.
Nick, on some of these transactions that you have sold, are buyers still able to do, rehab number 1, rehab number 2, and now rehab number 13 or so? All these investors that are buying these properties, and what are they doing right now in the latest round of doing rehab to the property? I mean, Michael said, $5,000-$7,000. Are you seeing that amount of money to be put in some of these deals? Is it less, more? What's it going into?
Yeah, I would say, more than ever before, creativity, and people are trying to be creative. I mean, obviously your basic stuff is likely probably done in most of these units, right? Your flooring, cabinet doors, and countertops, maybe not, backsplash, fixtures, appliances. Now again, some of that stuff gets worn down over time, and you have to redo it. And some of them you maybe went with a color scheme that you wish you would have chosen something a little different, and all that. But I think technology, smarter technology in units, and figuring out different ways to offer something that maybe your competition doesn't have is important. But I mean, I think ultimately, just focusing on giving somebody a really, really nice, clean, fresh place to live is really still what is winning the day. I mean, if 6-panel doors and, even upgraded baseboards and, just stuff like that is not ultra costly, but it makes a dramatic difference in these units that you see upgraded. And, for all the units that have been upgraded, I mean, we're reselling some deals that were some of the first quote unquote upgraded properties in the marketplace. And I remember walking in them for the first time being like blown away. And now you walk in them and you're like, kind of tired. There's newer, better stuff that's being done now. And so if that's your quote unquote classic, well, then that's great. You're inheriting a really, really nice classic. But I mean, I think with the competitive nature of the market, I mean, I think people are constantly pushing the envelope on what they could be doing, from an upgrade perspective. And then, common area stuff as well, little amenities in the office and, resident activities and package lockers and, all kinds of things that people are doing on that front as well. But I'd say the upgrade, it's not student housing where you are seeing all kinds of interesting amenities, and they're really trying to consistently one up the competition and attract these students. But it's definitely getting competitive out there, and there's definitely a premium for creativity right now.
What I certainly do respect about Nick is Nick not only sells apartments, but he also invests in apartments too. So that may be a quiet thing to say, but he puts his money where his mouth is. And so when he says that he likes multifamily, likes areas of secondary and say tertiary and then primary markets, he's an investor too. So he kind of sees a little bit of what's going on. And so he is helping from the hip of what you should be doing too. So Nick, what's the best way for people that maybe not know who you are? What's the best way for them to get in contact with you?
Well, our website is the easiest way to find us, and that is multifamilyadvisors.com. And you can also reach out to me directly, 972-755-5214. That's my direct dial in my office. And either of those, we love to connect. We always love adding folks into to our database. We love to meet new investors. We've got a big team, as we talked about earlier, and so I would say to investors out there who are like, "Hey, I'd love to get involved in multifamily, but I don't think I'm ready to kind of call on somebody that's doing a bunch of deals yet. I just want to kind of casually look." I think it's important that you do call, you do introduce yourself, and you do connect. We have the people that we have to connect with, folks that are looking to do their first deals. We want to grow with you. That's why we have a 75 unit and under team as well that are, helping investors get started in kind of smaller deals, and then we can help them grow into larger deals over time. And so I would just say, hey, reach out. It may not be me directly that'd be the best person for you to talk to, at least, on an ongoing basis, but I would absolutely love to talk to anyone and get them plugged in with the right person on the team that can help them achieve kind of their investment goals moving forward.
All right, Michael, final word, anything more to add to the conversation, then we'll say goodbye.
Yeah, no, I think I appreciate Nick's comments. I mean, I don't look at a lot of what Nick sells anymore. We're kind of more workforce housing. We've kind of graduated up, but I mean, it just is amazing to think of. We're talking about someone like the fifth generation value adds. I remember Nick sold a deal that I financed back when I was at Wells Fargo, and I was over in Bedford, and the guy was kind of one of the leading edges of value add at the time because no one was doing upgrades, and he came in and put $3,000 into a 1980s deal or something, put a dog park in, and just to kind of see where the business has gone. And that deal he bought for $30,000, Nick sold for $70,000, which we thought was just absolutely insane. I'm sure that thing's worth $150 now, or whatever the price is, maybe more. Just amazing. Kind of, yeah, but when he bought it, the rents were probably $650, $700, and they're probably $1,200, $1,300 today at the same property. So there's some real fundamental things driving the valuation. So better interest rates, better debt products, and materially higher income at the same time. So I mean, I think. Again, with operations, I see all gas, no brakes for the foreseeable future. And I think we're going to continue to see price escalations. And like Nick said, won't probably be too long before we're saying, remember when you could have bought that for $150 a door, or that 80s deal in the mid cities, and now it's probably $200,000 a door. And hell, that might be in 2022 for all we know. It's amazing to see the growth right now. It's kind of the golden age of the business for sure.
Unbelievable. So Nick Fluellen with the Fluellen Hoover team, Marcus Millichap in the Dallas-Fort Worth area. He is the guy that you want to build a relationship with him or one of his team, but he'll be the gatekeeper to tell you exactly who you need to talk to on his team and build a relationship with Nick, because it'll certainly help you get to where you want to be. All right, I'm Paul Peebles. That was Michael Becker. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.